So welcome, good people. This is gonna be my first installment on this YouTube channel, and I'm gonna brief us on the basic things that I'm gonna be releasing, the core things that I'm gonna be releasing in this YouTube channel. So with that being said, I would like to first of all clear the air that I'm not gonna be teaching the basic things that concerns forex, like what is forex trading, what is the pip count, how do you place your buy and sell, how to modify your trades and all that, all those basic things. I'm not going to be touching that in this YouTube channel. I'm going to be teaching forex 201, which concerns the technical aspect of forex, how to read price action, and use the information you get from the price to your own advantage, and also to make hypothetical profits from the market. Remember, this market is not guaranteed and you could lose your money trading forex. So everything that is going to be shown on this video is just hypothesis, and I won't be liable to any win or loss. So this is just me showing you how I understand price, following the concepts that I use. So let's move on to the chart. If you're a novice or a new trader or a noob, you would consider this market to be random. That is, this candlestick springs randomly, and no one can really get it because it's just so random. While on the other hand, if you are an experienced trader, you've been trading for a while, and you get stopped out almost all the time after placing trades upon trades, you get stopped out. You don't make money from this market. You think that this market is actually controlled and they are actually stocking your trades. Like whenever you place a buy, the market goes the other direction and all that. So bringing these two ideologies bringing them together, you see that the experienced one, the one that has actually placed a trade, that has actually traded for a while, could be right in a way, because whenever he places a trade or she places a trade, he gets stopped out. Now, no one is monitoring our trades. No one knows where our stop loss is, or our take profit is, or where our buy position is. The market, or the algorithm should I say, does this with the help of seeking for liquidity in the marketplace. The algorithm knows where the majority of the stop loss resides, and the algorithm is going to move price to that area to clear out those liquidity, or to convert those pending orders into market orders in order to move price. So that's just the core thing anyone needs to understand when coming into this market. This market is not random. It doesn't move based on buying and selling pressure and all that. So now, if you look at this price action here, just this fractal here, you see that so many logic has been destroyed from this fractal here. So many logic has been destroyed. Even though you trade price action, even though you use indicators, so many logic have been destroyed here. So the first logic I'm going to show us is the trend line trader. The trend line trader considers a two touch in the market, two swings in the market, either two swing high or two swing lows, and connect the dots. So this is a perfect example of what I'm talking about. This particular swing low and this particular swing low, because price moved away from there impulsively. This is a nice rally, a minor retracement, another rally, then dip into a discount, or should I say, then move up again. Now a trend line trader will see that probably the market has changed gears and would want to buy for a while, and he's going to connect the dots like this now, and he will be hoping to buy at the third touch here, which actually the market didn't reward him or her, and market eventually went the other direction. So this is one of the methodologies every new price action trader learns. We all learn how to use the trend line, and which eventually breaks us rather than makes us. So now a trend line trader would like to buy here, and if you draw a twin line and connect it to the upside, you'll see that a trend line trader would expect price to rally from here to this upside, at the third touch of the trend line, and hopefully sell from there, because they need to swing highs or swing low to draw their line. Some actually buy from the second touch with the help of a Fibonacci retracement. That, well, I used to do that as well. When you look for support like this, you look for a support like this. This is the support, and expect price to retrace into the 50% of this whole swing. 50% of this whole swing, this impulsive swing to the upside, and they draw a Fibonacci after price start breaking down. Once price hits a support at a particular level, either 50% or so on, they buy from there. But the market doesn't reward them all the time, and you need so much courage to do that because you eventually get it wrong over and over and over, and you'll be taking losses without knowing why you're taking losses. So that's all it. And trust me, there are better ways to look at this market. Not the best way, but better way to look at this market. It's to look for liquidities in the market. Liquidity in the market. Now, where do liquidity reside? Liquidity resides at every swing high and every swing low in the market. This is a swing high, these are swing highs, and this is a swing low. Swing low. Liquidity resides at every swing low in this market. Okay, so just know that liquidity resides. When the market moves away impulsively from a level, so many traders would like to, just for this level for example, this is an area where price moved away impulsively, so traders would like to sell from here. When price returns, they will consider here as a resistance, and they would like to sell off from there again. So with that idea, you know that they are going to place their stop loss just above this high, just a little bit above the high, and place their entry somewhere around here. So with that ideology, you know that liquidity is already being built in the market. So many traders that are already selling from somewhere here. When market is breaks down impulsively again, they are going to move their stop loss to somewhere above this high. So you know that this high is already a suspect, because so many stop losses are above this high. Stop losses, or you call them buy stops, are above the high. So you expect price to take out that high. We anticipate that price is going to buy to that area. If you're institutionally minded person, or you look for liquidity in the market. So this is what the market did. The market started moving to the upside, hunting for this high, this particular high. And you can see price trades into the high impulsively it made an impulsive move to the upside, drops down. So market has already converted all the buy stops here to market order, and all the stop loss have been triggered out. So market took the liquidity up here and start breaking down. So if you're institutionally minded person, you'll be watching price, looking for confirmation, signatures that the market is going to hand to you in order to buy or sell. So when this thing happens, immediately you consider this new high that is created as your point of interest, depending on what price does later. So immediately price break into this high, grab all the liquidity. You know that after a buy side liquidity is being taken out, the market is going to look for sell side liquidity, which rests below the string lows here. This is the sell side liquidity where buyers have their stop loss already. This is another one. And this is another one. Okay, these lows, their liquidity. Okay, this one and also this one, their sell side liquidity where buyers have their stop loss placed already. So when price rallies into this high already, taps into the liquidity that is resting above it, you expect price to go and hunt for the sell side liquidity, which is this. Market stalled for a while here, consolidated, then started breaking down again, grab the liquidity that is here, and here. You can see that market breaks down and grab all the liquidity that is there. Immediately price grabbed all the liquidity, converted all the sell stops into market order and start moving impulsively. Now after price grabbed the liquidity from the upside and the downside, you know that the initial move they made, which was the fake move, would be their point of interest. Let's just assume that when market was approaching this point of liquidity, this swing high, they bought from this candle, this impulsive candle. They added more money, or they placed more orders, and market made an impulse move to the upside. Okay, we know that they could be buying from the low here, but you see this impulsive candle, this strong candle. Let's just assumptuously say the market makers placed more entries into this candle and it dug into this liquidity. Okay, then they start dropping down, and immediately we assumptuously say price bought into this candle, this particular open of this candle. Now when price start breaking down to the downside, you know their buy position here will be in a loss, and you know market makers don't usually take loss. They either break even their trade or they make profit. So, and they have deep pockets to hold loss for a very long time. So when price start breaking down, they are in net loss here. Okay, and they've grabbed all the people, those people that are buying along with them that didn't close their position, or those that would like to sell at the breakout of this swing lows. The market makers is going to grab all the liquidity, stop them out, then they will come back to this area which they bought from initially. Okay, they will come back to this candle, this last up close candle which they bought from, they placed the last position from. Okay, this last up close impulsive candle which they placed the last buy position from, which they are actually having a losing trade on. They will come there to close their buy position and add more sells. Okay, because assumptuously we believe that they bought at this candle and sold here. Okay, price sold, market makers sold at this after creating a new high here, grabbed all the liquidity, they sold in order to grab all the liquidity below here. So they are buying here and they are selling here. So they have to come and close their buy position and add more sales. Okay, and this is exactly what the market maker did, or the algorithm which controls price did help them to do. So market actually the price actually came up into this swing, into this up close candle. Okay, tapped into, closed their buy position, which is actually a break-even trade for them again, and added more sell. So they are selling here and they are selling here. They are selling here and they are selling here. Now the idea is they have tricked so many people to join them with the buy movement, and they have tricked so many people by creating a double bottom here, expecting price to bounce up from there again. They've created so many patterns here, expecting people to place more buy positions and take their money. Meanwhile, the original plan was to sell, so which they are already selling here, and they are going to clear out all the lows here. They're going to clear out all these lows, right? Let me quickly take out this line that I see. They are going to continue this bearish movement you already have from the higher time frame. See, the higher time frame is bearish, so they are going to continue to the downside fully. Okay, they are going to clear out all these buy. Retailers will see this as a strong support zone, and they want to add more buy position into this place. Some people are already buying here, and their stop loss will be below here. So the market makers know people are going to do this, so they know that this place is already flooding with liquidity. There are so many liquidity resting below these areas, so they are going to drive price through there in order to move the market. So they are selling here. Their initial position was there, the added move position here. You can see the move away from there, from that area, is impulsive. You can see the move away from there is very impulsive. So this is basically what the market does, and if you really trade against them, you're not only going to lose your money, you're not going to find consistency, because they are the big players in the market, and they are the one that controls the market. So why not play the games that the big players play? Okay, so you see, those that trade support and resistance will see this as a strong support, and they would like to buy there again, because price actually moved away from there the first time, moved away from there second time, tried to move away the third time. You see this consolidation over here. Retailers are going to believe that this is a strong support. They will be adding more position. They will believe, oh, price moved away from here the first time, second time, you see, and price here is holding price. They will believe this support very well to hold price, and they're going to add more positions. Some are going to leverage more than 50% of their account. Some are going to use full margin because they've seen a good zone where they could buy from. So that's exactly what they're going to do. And you see what the market did. Market actually didn't reward them, and it moved the other way impulsively, you see, and created another low here. Started buying from there. Immediately market moved away from here again. It is creating another sentiment here that this is another strong support, and when price returned there, could buy again from there. So the traders that were trying to buy this move are already in tears, because they already stopped out, and those that will try to buy from here again, they will, well, I'm not in position to say, but if I'm in position to say, I would say they might not get their reward, and they will probably get stopped out, because the market makers are already selling here and they are selling here as well. So why not learn these signatures and play along with them? And if you can see, I'm already in this trade. See, I'm selling here, selling from here. My initial sell limit didn't get filled by just a pip. I missed the entry with just 1 pip. I wanted to sell right here, but I couldn't get the fill. So fortunately, when I scaled down to lower time frame, I saw another signature where I could sell from, which helped me to enter the marketplace, and now I'm driving down to grab the liquidity which the market makers also want to grab. I'm riding along with them, and this is just it. So I removed my stop loss because I wouldn't want to, beyond the scope of this lecture, I wouldn't want to teach you how to place your stop loss yet. So I'm just teaching you the basic things that I'm going to be introducing to you we all in this YouTube channel. So I hope this is insightful and you learned something. So if you haven't hit the subscribe button, please do that, and like the video, toggle the notification bell just so you will know when I place another video. So be safe and good trading.